on, we are also taking stock of a handful of finance companies and keeping up with the earnings conversation. L&T Finance is also in focus, where the net profit has risen 17%. And the net interest margin guidance, on the other hand, has lowered. And my colleague Harsh has caught up with Sudipta Roy, he's the Managing Director and CEO at L&T Finance, to decode their Q2 earnings and outlook going forward. Listen in to a slice of that conversation.
Yeah, so, as you said, there have been some systemic/sectoral challenges in terms of asset quality, primarily in the microfinance sector. And obviously, in post the general elections and the heat wave, we had seen some weaknesses also in sort of the unsecured lending. I'm talking about the industry, the unsecured lending industry, as well as some adjacencies in two-wheelers as well. However, the fact is that in Q2 also, we saw certain headwinds with regards to the microfinance sector, and I'll be very quick to point out that though majority of the industry headwinds, from whatever news which is available with us, what we track, is primarily because of customer leverage issues, but our sort of problems have been lesser of due to customer leverage issues, but primarily more due to sort of environmental impacts like the once in 60 years sort of flood situation in North Bihar, the flood situation in South Bihar, as well as in some states, some of the temporal disturbances that were brought about by the stoppage of the social benefit flow for a couple of months on the backdrop of the general elections. So overall, our sort of collections efficiencies have held reasonably well, though there has been a 13 basis points deterioration from June to September in terms of collections efficiencies. We came in at about 99.43% in the month of September 2024. And I do expect that sort of the weakness to continue into the month of the quarter of October, November, December from an industry perspective. Other businesses, what the deterioration that we saw in Q1, especially on the backdrop of the general elections and the heat wave, that took time to stabilize. It has stabilized in Q2, and we expect that during the festive period, the situations will improve. So overall, yes, a tough quarter, a mixed quarter. But again, what we have done during this quarter is to make sure that our credit engines are furthermore sharpened. As you are aware that we sort of operationalized our three-dimensional credit engine Cyclops last quarter, and we have continued to scale it up this quarter. 55% of our two-wheeler sourcing is coming in through that particular engine, and the initial trends are good. The net non-starters for our Cyclops underwritten portfolio is 125 basis points lower than that done by the legacy algorithms. So though it is in a beta stage, we remain very upbeat about the performance that is coming out of it. So yeah, overall, tough Q2. I think it will be a tough Q3 as well. We have to be cautious, and we have to place every step with an extreme caution. But again, the focus on growth momentum and a risk-calibrated growth momentum will continue with a completely tight control on risk, our portfolio origination, as well as portfolio monitoring.
Sure. So where should credit costs therefore lie in your viewpoint? You've got a good lens as to how things are playing out geographically as well. So 2.5 to 3% roughly being the credit cost H2, is that something that we can expect?
See, without going to specific numbers, the way we have sort of guided the markets is that our credit cost plus OPEX as a block will come in at about 7%. Right. So if you see this quarter, we have had some efficiencies in our overall OPEX. We had come in at 4.17% of book. The credit cost went up to about 2.59% of books, but overall it remains well below that 7% threshold. So, our focus on collections will remain in Q3. We will try to see, how best we can do in Q3, whether we can better the numbers than what we have done in Q2, even though sectoral challenges remain. However, what we will try to do is that the credit cost and the OPEX as a block, we will try to contain within 7%, as guided within 7%, which might mean that we might have to tighten our belts on the OPEX side. So, if, for example, if we see that, there might be a couple of basis points spillage in credit costs upwards due to the sectoral challenges. However, our objective will be to make sure that we continue on a holding pattern.
So where within OPEX are you, trying to taper and trying to control as we are seeing a bit of a spike with regard to where credit cost is concerned?
See, obviously, some of the the calibrated expenses, like expenses on above the line marketing, or making optimization in our technology expenses, especially our cloud costs, as well as barring collections, maybe trying to see if we can sort of optimize our hiring trajectory, etc. So we have several levers which are available with us. So obviously we are working on making sure that we build certain efficiency in our OPEX line, as well as continue to invest in collections. I would like to say that though during the period, we actually have significantly beefed up our collections infrastructure. In the rural business finance or microfinance vertical, we have put in almost close to 1,000 additional people in collections. We have beefed up our collections in our two-wheeler business. We have beefed up our collection strength in our tractor business. So overall, we have invested in our collections business just to make sure that our credit costs remain in a predictable trajectory, as well as on the overall we have made sure that our OPEX remains in control, so that we are able to guide and come within that 7% block of credit cost plus OPEX.
Okay, there you have it. Well, that's the management of L&T Finance, but we move on.